What is up, you guys? Welcome back to the channel. Everybody Eats. We've got another something special for you guys. Today we're going to be talking about hedging, what it is, when to do it, and how it saved my ass from being negative on the day. This is the SPY. It's an exchange traded fund that tracks the S&P, so it tracks the market. You can also use DIA for the Dow Jones or QQQ for the NASDAQ. I personally like to use the SPY because it has the best prices for option contracts and it keeps its spreads low, which makes it, in my opinion, the best out of the three that I just listed to trade on and to use to hedge on market sell-offs. We'll start with Google's straight up definition of hedging. Hedging is where you open a position that goes against the current open position. So if you have an open long position on Apple and you wish to short Apple because you think the price will fall in the short term, but you don't want to sell the stock because you still want to hold it, then this is a way to get protection against the market selling off. So my fellow retail traders, you should all know that when the NYSE, the SPY, sells off, that's going to drag stocks on the New York Stock Exchange down with it. That's how this works. So we'll use my account for an example. I have several stocks on the New York Stock Exchange that I was not ready to sell yet. I still want to hold those for a week, maybe a month, or however long. But in the mornings, we saw that we had a bunch of selling pressure pre-market, and when the market opened, we started to tank. Therefore, we knew our open positions in the stock exchange were not going to be benefiting at the open, as we had this big movement down by 9 o'clock, and then we continued to have selling pressure. So what do you do in a situation like this? Well, you hedge. You don't panic sell and take a loss. Instead, you can go ahead and buy a put with a trailing stop loss at whatever you so choose and ride it down, and this will compensate for whatever your losses are in the stocks that you're holding that you don't want to get rid of. So I was able to hedge by buying puts in the SPY with trailing stop losses to go ahead and counteract the losses I was getting from being dragged down in the market by these New York Stock Exchange stocks. And one of the best ways to see the selling pressure in the mornings before the day actually unfolds and begins without just looking at the price action, because price action is your biggest teller. But what you can also do is you can look at the Market Watch tab on TD Ameritrade Thinkorswim, and it will give you the advancing versus declining stocks and the total capital for stocks being bought versus stocks being sold. And this can show you the pressure and kind of give you an idea of the direction for the day. So that way you know whether to hedge or not for the day. And I'm going to always keep it real with you guys over here at Everybody Eats by showing my actual account and what the fuck is going on. Alright, drop a like, drop a subscribe, help your boy out, and most of all, take it easy.